Everybody in? I think we're just waiting on Judith joining. Oh, sorry, everyone's here. Good afternoon and welcome to our second panel discussion for the day, where this morning we focused on an all-cap approach to the UK. This afternoon we're focusing a bit more on small caps. We've got Georgina Britton from JPM, Judith McKenzie from Downing, and Dan Whitestone from BlackRock. And we're going to just put some questions out to them. You've got a Q&A box on your right, so please keep them coming in. And we'll address many. Everyone's going to be presenting on their own trust this afternoon, so if you have very specific questions, say trust, it might be better to save it for then. I'm going to just run through a quick slide to introduce us here, and then we'll get started. So, UK small caps look relatively cheap compared to their global peers if you look relative to their own history. Yes, on an earnings basis, they're slightly above average, but that is a wee bit depressed earnings, I think, last year. It's probably fair to say. And when you look at a tangible book basis, it is below the 10-year average. I think it's fair to say that also over that 10 years, it's probably been a quite cheap market anyway compared to those. So possibly we're seeing a little bit of pressure here. We can see that producer prices are higher and yet consumer prices are lower year on year. So at the market level, that's potentially implications of margins. But sterling's been strong because people are coming back to the UK. We've seen it in sentiment surveys too from the likes of BAML. International flows are coming back. Now, the bond market in the US, which is a global proxy, is suggesting that they think the Fed is right, that inflation is transitory, when you can see the divergence here between 5 and 30-year tips. My slides are broken. Nope, there we go. That matters because the market has been acting as if it's a reflation market, the UK small cap. We've got the newest small cap relative to global markets here in in orange, and that's against the metals and mining index. It's something we highlighted back in February, and it's continued to sort of relatively hold true. There's a lot of zombie companies in the UK. This is from the Bank for International Settlements, and this is true basically for every major developed economy. So I think the reflation thing is sort of a reflection there that these companies are more viable. And yet the market seems to price this in. This is from Schroders, and this is the valuation dispersions within the UK market, which is at record highs. So I think the market, it's fair to say, is recognizing there's a lot of difference within it. Doesn't matter anyway. You buy active UK small caps, you get good returns, has been the message from the last 10 years. This is the information ratio, so this is the active return you get for the active risk you take. So, keep the questions coming in, and I'm going to put the first question out. Dan Whitestone, is the UK just a value reflation play globally, UK small caps?
Hi, Callum. Well, the simple and quick answer is no. Anyone who knows me knows I can never give brief answers. I always apologise in advance. Look, I listened to your opening brief, and it's just there's some interesting points in there. I just think that the whole point of fund management, active fund management, is not to pick the average; it's to pick differentiated, and that's why I don't really deal in averages. And I think when you look at the world of small mid caps in particular, it's just a weird, wacky, wonderful home to 1,600 companies. And much of their success and failure ultimately comes down to management, strength of business model, industry dynamics, and ability to self-fund or not. And you've seen it over the cycle, and 2020 is a great case in point. And if you just pick one metric, there were many consumer services companies last year that did very, very badly. And there are many other consumer services companies that did incredibly well because they're able to pivot their business model, or they'd invested heavily in online capabilities in previous years. Or in the case of Games Workshop, they just had a product that people really want. It has incredible scarcity value. There is no replica. They had an amazing online operation. And they basically just hit the two fastest growing channels of US wholesale and online to great effect, and had their best ever year for sales and profits. And so in any normal year, people will think Games Workshop's totally exposed to unemployment and consumer confidence and GDP. And I think as year after year shows that GDP is becoming just a completely irrelevant metric when analysing successful failure in this universe. And so there's so much more to UK small mid caps than reflation. There's some phenomenally great companies there that are going to do great things, and there's some dreadful companies out there that should be avoided at all costs. It's an amazing place for active investors like the three of us to ply our trade.
Georgina, did you agree with that?
Yes, I do. Very, very nicely put. No, exactly as you just heard from Dan. There's so much more going on than than your little sort of glib summary. Not to be rude, you know, and I'm sure the others would agree. I mean, I think some of it. I mean, I've been running small cap money for north of 20 years. And right now, and I tend to be excited about this space most times, but right now I'm about as excited as I've ever been. And for us, that means for our investment trust, we're at our maximum gearing, which is 10% set by our board. And we are literally in sell to buy mode. We've got so many things we want to buy, new IPOs, but also existing companies we want to get back into, get into, add to. And it literally, as I said, it is sell to buy. So we're kind of crawling through the portfolio to find things that we can bear to let go to add to others. It's a great time.
And Judith, for yourself, you operate even further down the market cap spec, I think it's fair to say, in the microcap spec. Is it? I mean, is that what the dynamics there, or are these companies like Georgina and Dan said, it's quite indigenous, the drivers of growth?
Well, I mean, the great thing about being a stock picker, and we invest in between 12 and 18 companies, so we really are bottom up. And the great thing is that we can rip up your slides at the start and the macro and actually speak to the companies. And that is the real barometer. That's what our job is. That's where we're hopefully adding value. And I've been looking at headlines over the last 10 years or so, saying that value's dead. The only thing that's different in the market is that it's been pumped full of, I don't know, 895 billion or whatever, trillion, maybe the number, of fiscal stimulus. And actually, you remove that and you probably would see much more of a tilt towards value, as we've seen through the last, well, when did the whole Gazette start? 1956, I think. And you can see the tilt between value and growth through that cycle. And I don't really think much is different. It's not just a tilt. I think, these companies, we just talked about them, they're quality, decent businesses. And you can see that from the inward M&A in the small cap and the micro cap market over the last 2 or 3 quarters, that's way higher than even pre-COVID. So these companies are cheap and they're good quality, and that's why we're investing in this space.
And that sort of comes back to something you were mentioning, Georgina, that you're having to sell to buy right now. Is that how does this sort of period in terms of depth and breadth of opportunity, how does that compare to what you've seen previously in your career?
Well, as I said, really right now, this is, I mean, I have seen it before, but not for a while to this extent, where it just, as I say, and it's breadth. We're not just, focusing on any one area, and it's not just IPOs, although there've been some really exciting ones coming. I think it's fantastic that we're seeing, this amount of sort of fresh blood, as it were, coming into the market. But as I say, it's across the piece. I just wish we had more money to be able to just add without selling.
And yourself, Dan, I mean, you took some quite high conviction positions last year. Are you rotating your portfolio right now, or are you running them as you have been?
It's going to be one of these panel discussions, I think, where we all need to end up disagreeing with each other. Look, Georgina said something which really, I'm going to answer the question in a minute, okay? I'm just going to go off on a tangent. But Georgina said something which really resonated with me, which is that she's an optimistic, bullish person. If you are an active small cap manager, I think, if you're any good, you will be optimistic and bullish, because I go into all these client meetings and we talk about averages and stuff, but ultimately, I can't do Games Workshop justice in 2 minutes. I can't do Gamma Communications justice in 3 minutes, okay? But if you sit in the meetings that we sit in, and you sit in the investment debate that we have as a team, and you go through the opportunity for some of the companies in our fund that have delivered year after year after year for us, and are going to deliver year after year after year going forward, you cannot help but be positive and optimistic. If you own a portfolio full of legacy high street banks, of course you can sit there obsessing about GDP and inflation and versus macro, but these things just don't apply in this world where mean reversion just isn't important. It's about great companies. Oh, look, over a few weeks, anything in terms of a share price, okay? Over years 3, years 5, the only thing that matters is a progression of cash-backed earnings. And so many of these companies that we identify through our work, exposed to exciting trends, can do great things. So look, I couldn't put it any better than Georgina. I've written this many times in all our communications. I am as most excited, the team are as most excited as we have ever been The net of Frogmorton's over 120%. Like, we took a big decision to take up a lot of risk last year. Like, there are so many opportunities, and it's not just about the new ideas that are coming through. There are so many companies leading change. This is the bit, like, there's two major things going on. Number one is the secular growth in many core areas that we like: digital transformation, cloud or digital telephony, digital payments, accelerating. It's not a pull forward, it's just a huge acceleration and permanent structural change in consumer and business behavior and spending. So that's a multi-year story. It's going to play out and drive revenue growth for many of our companies in the years to come. Two, and it comes across in every crisis, and 2008 is a great example. In every crisis, you accelerate corporate Darwinism and you accelerate market share shifts. And it's no coincidence the best companies that came through 2020 had a product that people wanted and had a balance sheet that could self-fund their own growth. And those that come unstuck generally are companies that have the wrong balance sheets. And if I pick on like electric components in the world of component distribution, the abilities for them to keep on accelerating their market share gains at very elevated rates is incredibly powerful. Just like we saw with shares that Georgina and I went over many years, like Howden Joinery and Ashtead back in 2008, that came out in 2009 with a far stronger market position, and then saw 4 to 5 years of incredible growth, even though their end markets didn't recover, purely through market share gains. And then they enjoyed the end market recovery in the subsequent 5 to 7 years. The same thing's happening now across pet services, electric component distribution. Take Watch to Switzerland, another huge market share winner through 2020. These two massive drivers are what really gives people like myself and the team huge conviction in the opportunities that are available to us right now.
Of course, we've seen some private buyers coming in and M&A activity picking up. And Judith, particularly in your space, are you finding it? I mean, you mentioned that was a potential source of value realization for you in that space, but how are you finding you competing for ideas now with private buyers?
No, I don't think we are competing. Again, we're much further down the market cap scale. We're under 150 million market cap. And actually, if you look at some of the real gems that we're picking up, they're even under 25 million market cap, and they're sitting on 3 to 4 times PE, and they've got a growth profile when you look at 10-15% CAGR over the next 3 to 5 years. These are really nice little businesses. But what we're finding is that they really are overlooked, and they're overlooked by the general market because of MiFID and other things. But they're also a little bit overlooked by PE, because it's great, because PE get a little bit scared about us big fund managers or little fund managers, because they don't think they can get access to taking companies off market. And so be it. I don't think they should see that as a passport to getting hold of some of our quality businesses that deserve to graduate up through the ranks into small and proper mid-cap as well. So we are seeing what we are seeing within our portfolio. And again, we are very focused. We're taking between 3 and 25% of the underlying businesses. So we are quite strategic. What we are seeing is international M&A activity, both trade and PE, getting interested in these businesses. And quite frankly, I'm very happy to be owning a decent, almost quasi-controlling stake alongside other good fund managers, where we're not going to let them go for what are, I think, quite really very cheap prices. So it's great to see that activity, but I hope that UK fund managers hold firm and don't sell out too cheaply.
Mm-hmm. I mean, UK is obviously perceived as being quite light on technology. Something got coming in, and do you guys perceive that to be true? Or I'll give you first dibs to answer, Judith, on this one, I think.
Yeah, no, we see some fantastic technology companies, really good. I mean, again, it's all about relative, isn't it? So maybe relative against the States for if you're sitting in Silicon Valley or wherever, yeah, absolutely. But if you go out and you dig, then you can find some really good innovative technologies that, we're great in renewable energy at the moment. We've got some real niches, and I think it's having that blanket approach to say the UK isn't good in tech. It's quite disappointing to hear that. And okay, it needs to be grassroots. It needs to literally be fed from venture upwards. But we're certainly not seeing a dearth of good technology companies, that's for sure.
I mean, I do unfortunately fulfil that stereotype of UK being useless at tech, but even I can manage to operate this. Is this kind of video conferencing, Georgina? You find opportunities and things like that, or is it from working from home? Has that thrown up opportunities for you in the last year?
Video conferencing, where I said at the beginning, I hate WebEx. I think we should only have Zoom. I love Zoom. I can do Zoom. But no, to be honest, I'm going to come back on tech, but I absolutely love working at home, because what it allows you to do as a fund manager, the only thing we actually want to do, apart of course from presentations and telling our story on events like this, is look at stocks, dig, look at the fundamentals, look at stats, look at numbers. It's actually a very solitary job. And then with all the technology that we have, I mean, we've got an internal online chat, which is about as close as you get to sitting next to your colleagues, just chatting all the time, going, oh, by the way, have you just seen this? Oh, and then when you need to, you Zoom, you pick up the phone. So with the people who really matter, the team, my team, I've felt almost as close to them as sitting next to them. But as I say, just having the quiet time and less of the politics, I absolutely love it. But coming back to tech, it's fascinating, isn't it? I wanted to add two things. People always say, the UK is, clearly is massively underweight on tech. They're looking at the FTSE 100. They're also sadly looking at the FTSE 250 to an extent, but further down the market cap scale, it's simply not true. And there are a lot of incredibly exciting companies around there. But the other thing, and Dan kind of touched on this a little bit, the real truth is that it's not just technology companies that have technology. So I mean, one of the great two actually. He touched on, say, Pets at Home, which is a company that has transformed itself over the last 4 or 5 years, and one whole part of that transformation has been data management, data collection, usage of data, and then looking at the large Silicon Valley companies and going, subscription model. How about that? Can we start adding that to our whole model of business? So a second example would be another retailer, Dunelm, which we were very large investors in. We have been for a couple of years, and the key to us getting back into that name 2 or 3 years ago was management starting to completely openly admit how behind the curve they were on technology, and not just the website, the front end, but back end too, and commit. And when I say commit, I mean I believe their figure was sort of over £50 million that they've spent on technology. I went along and actually spent time with them and talked to their tech team, because this is absolutely crucial. To be a modern retailer, whether you're online, offline, a hybrid, etc., technology is a part and parcel of how you retail now. So I think I mean, technology. Do it the other way around. Try and think of companies now across the piece where technology isn't an absolutely crucial and core part. And if management don't get that, you probably don't want to be invested.
Dan, anything you'd like to add to that? I think I saw you nodding along there, but is any point of divergence on that?
Yeah, really nodding along. I own both those companies, but I need to put it really well. I do get frustrated though, if one technology company or one company that people call technology company IPOs and does badly, suddenly it's bad for all technology companies, and ultimately they're not. They're just not all the same. I just couldn't agree more. There's so many companies in my fund that sit in financial services or consumer services or even industrials, and to me they are technology companies with just a consumer front end or a financial front end. I mean, I've always thought of Hargreaves Lansdown as a technology company personally, and I think even I just look at some of the names that we've spoken about, like Games Workshop, Pets, Watch to Switzerland. We don't think of them, as Georgina said, as technology companies, but boy, have they leveraged technology and changed their business model in the last 15 months to great effect. And I think that's a very, very powerful thing. And ultimately, it often comes down to, it's not luck. It's number one, management, foresight, intelligence, vision, execution. And two, it's having the financial firepower to do it. And without those two things, it's kind of irrelevant. I always think it's so overlooked in the stock market that it's absolutely no coincidence that companies don't persistently have good luck. It often comes down to the management teams that actually have the vision and the ability to go ahead and do something, and more important, they can fund it. And it's no coincidence that so many companies that find themselves in a whole load of trouble generally have weak management teams and generally have backed themselves into a corner. Maybe they pay dividends for years they can't afford. Maybe they've chronically underinvested in their people, plant, property, and equipment. And then unfortunately, the world changes, regulation changes, technology changes, consumer behavior changes. And suddenly you find yourself increasingly redundant with an underinvested business, and the wheels can come off very, very quickly. And again, 2020 is a reminder of that. So lots of opportunities out there, and I agree that technology is a real enabler for the most successful companies.
Mm-hmm. I mean, you touched on governance there, obviously, and the importance of management. One of the questions we've had coming in is about companies choosing to stay on AIM, and if that's any potential, if management teams are choosing to stay on AIM, is this an issue for governance for you, or is this more just because there's just less, it gives them greater freedom to execute strategy?
I get this question all the time. Like some of the worst. Well, I have to be careful what I say. Some of the biggest examples of destruction of shareholder value have occurred in the main market and in very recent times. A couple of bad rotten apples in the AIM market, should not tarnish some very, very successful, well-run companies. And I just think, again, people, it's not about averages, it's about individual investment cases. And for some companies, it makes total strategic sense to stay on AIM. If they have burst onto the scene with some new widget that's going to change distribution, or it's going to replace other widgets because it's got better features and they can charge for it, and they have a very small market share in a large fragmented market, and they want to keep doing acquisitions to build that, it makes much more sense to operate on AIM when it comes to raising money. So ultimately, it's down to the fund manager to work out if you have an issue with the governance or not, and whether you think they're good custodians of capital. And it's up to you if you want to invest in the shares and what weight you want to have them. But I really don't think it's as simple as like thinking that companies in the main market all let's stick them in the blue corner of like successful corporate governance, and let's put the regulatory like AIM market in the red corner as all the opposite. So I just think we need to get into companies on a stock by stock basis.
Callum, can I just add to that? So I completely agree with you, Dan. This is a bit scary because we're now agreeing on so much, but maybe, I mean, it's almost, 20 years ago, that was a really valid question. And, there were real dregs, that there were a lot of overseas companies with shocking corporate governance, et cetera, et cetera. Now, as you say, what's fascinating now is half the time, I actually can't tell you off the top of my head whether companies main or AIM, because I don't care. Because exactly, I've done my work. I know I'm invested in the company, and I know the corporate governance, is ticking all the boxes for me. So it really has now got to that stage that it is a complete irrelevance.
Yeah, I think I would second that as well. I don't actually understand the question, because the AIM market is doing its job. It's an efficient market, and it's a good custodian for great little businesses. So yeah, I don't understand why there needs to be even a thought that a company goes to AIM and then has to graduate up. That's the wrong way to look at it. It's an efficient market, so let it work. I do grant that you wouldn't necessarily go and invest in the AIM index as a whole, as a tracker, because it's got so many little nuances to it. And we talked about this at the very start. Dan mentioned at the very start. It's all about that universe that you can be a stock picker and you can find some great companies. That's all you want as an investor. You want to get access to companies, and that's what AIM allows. I think governance in its own right is a question that obviously is far more up the agenda than it ever was before. And we now see boards and management teams taking proper responsibility for it. And that's a great thing. But ultimately, it's the fund manager's job to figure out if there's good eggs or bad eggs on the board and make the decision. And that's what hopefully we get paid for, or we sort it, because we can vote, which is another good thing.
And are you starting to see in the AIM market participation more all cap flows coming in? Noticing it sort of on shareholder lists, people that are not specialists anymore. Is it becoming more mainstream?
I think what I'm seeing, sorry, I'm just jumping in there. What I'm seeing is that not maybe so much in our little microcap space, but what we are seeing is a really vibrant private investor network, and that's outfits like Mello and others that intelligent smaller investors who really are doing their homework in these smaller companies and coming onto shareholder lists. And that being able to engage with shareholders like that, I think even through Zoom and other mechanisms of the last 12 months has really helped the accessibility of small companies onto those radars.
I've actually got a further question on AIM just coming in from a private. Now, I'm going to remind you that your compliance departments will not let you name any specific companies in this one, but just what you would all look for warning signs, because as you all alluded, it's a broad index and there are some dogs in there. So what's a warning sign? What's a flag? What flags up for you right now, especially right now, but just more pertinently in general? Georgina, you want to jump in?
Yes, sure. So, I definitely my first point would be the question shouldn't just be about AIM. This is across the piece. Dan's already mentioned it. It just because you're on the main list does not mean that one should be investing in that company. Let's be clear. For me, I mean there are a number of flags. Absolutely, number one would be free cash flow. If a company is not producing free cash flow, you got to start with a huge question: why on earth would you be interested in investing in it? The second one for me, and this is all about every investor has a different approach to this. I mean, going hand in hand with what I've just said, I am just not interested in companies that are too early stage, which means pre-profit, because obviously they're not generating any cash, and for me they're too unproven at that stage, and you don't need to be the first into a company. You don't need to be there in the first 10 minutes, whatever it is of their success to make huge money. So those for me, those would be sort of two absolutely key ones. And just before I hand over, just on that, and there was an earlier question which I thought was definitely worth just addressing, which was asking about whether small caps are actually ready for recovery, or whether they need to be fixing their balance sheets. And again, from where I sit, and then definitely I'm sure there are companies with shockers of balance sheets still, but the let's call it the universe that I'm interested in, the investable companies that I'm interested in, not to be rude, but that's so a 2020 question. That's what we did last year. That's what I'm guessing all three of us spent an unbelievable amount of time on companies' balance sheets, and for those companies that deserve it, which were just literally in the wrong space, i.e., shops that had to close or travel agent that couldn't fly. Clearly, there were potential massive holes in the balance sheet, and the stock market and investors like us absolutely stood up and handed money to do the repairs. So I say there will of course be exceptions, but I think very largely, that's done and dusted.
Okay, but so I mean, on the balance sheet point, obviously a lot of companies that haven't moved might be in trouble now. But is the next set of opportunities going to be in companies that lagged last year that maybe get someone in to change it around and possibly do some equity raises to shore up the balance sheet and then execute new strategy, or are they just too late to the game now? Or the winners been decided? Dan, I think you might have some views on this.
Yeah, look, it's all case by case, and obviously Frogwater can short, and I really like shorting. It's intellectually, I mean, all the money is to be made in longs, right? As everyone in this panel knows, right? We can find companies that can go up 25 or 35 times, and lots of clients on hit for the first time think, oh my god, the guy's like crazy. Like most people deal in the world of like 30% or 50%, and we deal in the world of like 20 times, 25, 30 times. If you look at some of our holdings like Deca Pharmaceuticals, JD Sports, Games Workshop, and actually just see what they've done over a number of years, you'll see what I'm coming from. So that is where the big returns can be made. But we've shorted several companies that have gone to zero in recent years, and we'll short more that go to zero in the future. And obviously shorting over the last 14 months, as you'd expect in any, if a stock market in the UK falls 45% in 6 weeks, shorting from that moment in the next 10 months, 12 months is going to be hard. You're just in recovery mode. And Georgie's making the point, ultimately, it was very clear direction from government that, that banks like no one breached their covenants, right? Everything just sort of gets waived. So you didn't get the 2008 sort of denouement of everyone sort of like going bust. But obviously we've had multiple equity raises, but there's a huge difference. Okay, like there are many companies that we've given money to who are raising money entirely for offensive front foot reasons to absolutely capitalize on the opportunity in front of them. There are other companies that are raising money just to try and stay in the game. It's a very, very different scenario. And there are some companies out there now that still have completely the wrong share count. You know, we stopped asking though, how you worked out like how much money to raise. It was very simple. What's the maximum you guys are allowed to raise before an EGM? Oh, 19.99%. Funny, you're raising 19.99%. 12 months later on, yep, you raise another 19.99%. I do, like, generally speaking, the great shorts, to Jenny's point, are where, like, we're skeptical about earnings, even statutory profits, right? But the difference between adjusted earnings and statutory profits is getting bigger and bigger and bigger. The adjustments now to earnings are just getting crazier and crazier. And this is how you end up in a situation where, like, fund managers are writing blogs defending contractors, saying, hey, they're only on 9 times earnings. And you're like, really? It's a series of contracts. There's absolutely no cash flow. What are you talking about? Like, and guess what? They go bust. So, like, adjusted earnings makes a huge difference. So the only thing that actually matters is how much free cash flow are those adjusted statutory profits actually generating. So if you get to boil everything down to one singular metric, that's the most important metric of all, it is the absolute free cash flow and the conversion of those profits into cash. So that's a huge red flag for companies that cannot convert cash. There are, though, some companies out there, very quickly, that we are totally bemused by, that in this dash for trash, this sort of like 7-month vaccine, you know, let's buy the shares that have performed the worst. Too many people are looking at historic share prices, using that as some sort of like valuation anchor, and it's madness because the share count's increased between 20 and 40% since then. So like whatever the share price was back then is illusory. They're never getting back to 19 levels of profits, and everyone's forgotten between like 15, 16, 17, 18 and 19, this industry or company was facing massive pervasive challenges which haven't gone away. And so there are many shares that are already trading at a premium to FY19 level profits. Their industries are still in a difficult place. It's not like consumers have had some sort of change of heart and want to rush back into like legacy brands, and the share count's wrong. So there's some massive minor gap profit warnings coming in some of the recovery space. Then just a last thing, cost inflation in raw materials. I've never understood in an inflationary environment why you want to buy cyclicals that have no pricing power. I just don't get it. Like, if you're going to have cost inflation coming through your business, you absolutely want to own great companies that can pass it through. And many of the companies we've spoken about on this call are great examples of that. There are many companies out there that absolutely cannot pass it through. And I think there's definitely another minor gap coming of a known cost inflation on companies that have a poor track record in exhibiting any sort of pricing power. And so I think that can also be a sign of potential problems or things to watch out for going ahead in certain industrial cyclical areas of the market.
I mean, Judith, obviously in the microcap space, by definition, smaller companies, are they still able to exercise that kind of pricing power, you know, pushing it on to their consumers, are you finding? Or are they you having to really focus on the ones that have had locked in the best cost discipline?
Well, it's a combination of things. So, you know, go back to what Dan's saying. If there's a quality company, you can pass it on. That's as simple as that. If you've got pricing power because you're using or you're providing a service or a product that's quite unique, you can pass it on in seconds. And I say in seconds, you do have to have management teams that are brave enough to do it. But this cost inflation is not going to go away. We've been talking about it being a bit of a blip for a while now. But if you look at freight, when you look at our individual companies, when you look at freight rates that have gone up from £4,000 a container up to £8,000 plus, then getting us another surcharge of another couple of grand on it. And that's just, we can monitor this week by week. And so therefore the company, the management team have to be brave enough to pass on those costs right away. And we saw it in some of our food services businesses. And today I think General Mills has just said that the price of our Cheerios is going to go up by 7%. They've put price inflation right across the board. And so therefore, if we are sitting with a microcap company, we're naive enough to think that they're not going to have to push down price pressure, then there's going to be something wrong with it. So you've got to have a niche product. You've got to have a niche service.
And can they offset that if we see wage inflation, especially? Is that something they can pass on, or is this something? I mean, obviously that's a total cost input, but it's much less tangible to the end user, I think, maybe.
Yeah, I think what we saw with our businesses through COVID was, and we didn't think it was going to happen like this at the start, but they really knuckled down and their own cost bases became much, much more efficient. And that's the sign of a good management team. And they didn't need to be prompt and prodded to do that. They really drew back and retrenched in and looked at how to improve margins. And there's things that you can mitigate against when it comes to wage inflation. You can have good conversations with the unions. It's not all about just hard cash. It's also about being able to offer flexible working and a better working environment, etc., etc. So, it really is with our companies, it's right down to that micro level of detail where you're really looking, not just taking a sort of general macro view and trying to pull every single lever that you can. And that's the beauty of these businesses. If they've got levers to pull, then actually they can make quite a difference and they can survive through this. It's not going to be plain sailing, but they can survive through it.
I mean, Georgina, as a salary earner, I always love hearing about wage inflation. Broad-based wage inflation pressures is always very good. What are you finding when you're talking to managers right now? Are they reporting any pressures on staffing as they reopen things, as the economy picks up again, or is it? The companies you own, they got everything in place, they're ready to go?
Well, it's fascinating, isn't it? I mean, and I completely agree with what Judith just said. So if you stand back and look at the macro, I mean, first of all, it is astonishing that we're talking about this, and there's a good reason we're talking about this, given where unemployment is, given the amount of people still on furlough, etc. So just there's a little bit of a disconnect actually going on. So one might argue that the wage pressure that's definitely being seen in certain industries is transitory. But again, putting all that to one side, I mean, I think there's a very clear message from the three of us, and indeed pretty much any small cap fund manager that you'll ever speak to. It's not about the macro. It's not about the big picture. It's always the fundamentals. So I would say two things exactly to Judy's point. A lot of companies are not seeing any problem at all because exactly they tackled this. They tackled their cost base. They made some really, really hard and unpleasant decisions last year, and that's benefiting them. There's that on the one side, but on the other side, definitely there are companies and I mean, I think Dan's mentioned Games Workshop several times already. I'm normally the person who also does that, so I will just mention it here. I mean, they gave an additional bonus to every single employee last year because basically they said, my God, they earned it. And they said, to be honest, we're literally, we're worried about burnout. They didn't push expansion in a factory at the back end of last year, and they could see bottlenecks coming again because they looked at their staff and said, you know what? We don't need to push that hard. These people need a break. This is about our staff as, absolutely key stakeholders. So that's also the sort of thing we're looking at. So some companies definitely have put through preemptive wage increases, and they've told us about that and said exactly because they earned it, and or because the space is getting more competitive. We want to make sure people continue to be happy. And again, this is where I don't pretend to know the details of their industry, so I trust management and the good management who've been doing a great job. I trust them. If that's what they need to do, if that's what they think they need to do, they definitely will. But it's not not as big an issue as one might believe in our investee companies. If you read the newspapers every day, you would think it was a huge thing. It's specific industries and specific areas.
And similar for yourself, Dan?
Very to add, I think that Judith and Julian have made all the key points. Only thing that springs to mind is like one area I'm sure we have commonality is video gaming. If you speak to a video gaming company, they've been struggling with finding enough staff and inflation of staff for years. It's not it's not new. IT development. In certain skilled jobs there have been chronic shortages measured in years. Veterinary services. there's a number of industries where they've been back to this for a number of years. It's not a COVID-specific issue. It comes back to everything we've talked about, like, do you actually have something that people want? Is it unique? Can you charge for it? Etc. And I do think Georgie's absolutely right. We should never underestimate the power of a well-motivated, incentivized sales force, and whether it's Games Workshop or Greg's, another company that paid their staff a big bonus. I do think this really comes through in loyalty, longevity of tenure, of morale, and that ultimately translates itself into a better customer experience, which equals more repeat business. And it's like the old Charles Wilson of Booker mantra. And I just think those are good policies that lead to better, successful businesses. The restaurant shortage is a near-term one, and that's obviously an ironic one because of your point about but ultimately it's the government. It's the side effect of government policy. But there's a lot of people on furlough, and when Tim Martin, arch Brexiteer, is bemoaning lack of staff, and unfortunately, one of the reasons of that is Brexit, and people have gone home. But a combination of Brexit and furlough has definitely created a real short-term pressure in the hospitality industry, but that too shall pass.
I'm just going to combine, follow up on your point there, if that's okay. I'm just going to combine a couple of questions we've got in. One was following up from the roundtable this morning, where some all-cap managers mentioned that some smaller companies were having trouble accessing the European market a wee bit because of some regulatory barriers that have come up. But also, somebody pointed out, is there any areas where you think that the UK has real global leaders in the adoption of tech into these business models, and how, to get to your point, to the 20 to 25 baggers, are the opportunities there that they can overcome any kind of difficulties that are you finding?
Well, I think every successful company out there has overcome many difficulties in the past. I mean, I think about some of the mistakes that successful companies have made and how we've grown up with them on the journey. When you own companies for 10 years, you get to witness, it's like your own family, the pride, the shame, the needing to put an arm around someone. It's great. I just think that the most of the companies, to get the most, you generally have to be global. You can definitely drive a lot of shareholder value being a dominant player in the UK, but if you really want to make multiple times your money, you have to be able to sort of globalize that and then prove you truly are a global leader. It's no coincidence that Games Workshop, only until a few years ago, was pretty much a UK retail bricks and mortar led business, and now the UK just on the third, and online is a huge part of their sales. Decra is a truly global company. The list goes on, and I think that is always key in improving it up. But in terms of about where do we lead, we've always led in certain niche industrials. I've always thought the Southwest of England, the Renishaw and the Spirax Sarcos, we have some incredible global leading industrial companies that put technology at the heart. We have many companies in consumer services that are global leaders. Generally, they dominate a specific niche, though, which is why their market caps are where they are, and it's why the FTSE 100 is still the same FTSE 100. But there are some phenomenal global niche leaders in the small mid-cap market that have really reinvented themselves further abroad.
Is that true even in the microcap space, Judith? Are some of your companies able to generate sales and growth abroad?
I mean, it's amazing. So, I could tell you out of our 15 companies, we've got a dominant supplier in smoke and fire alarms worldwide. And you'd think that market was dominated by the Chinese, but there's really only 3 main players. And this little company, Fire Angel, has a third of the market. And if you go into B&Q and any Screwfix or whatever, you really can't buy any other product. This is a little company that's on AIM that nobody probably has ever heard of. And then you've got another company called Bolex, which is, I think it's probably the number 2 or number 3 largest player worldwide in cable assemblies. So putting cables together for MRI scanners and Teslas or whatever. And, this is a company that's based in the UK. And then you've got another little business called Synectics, that another global leader in command and control CCTV. So you go around the streets of London and you'll get recorded by a lot of Synectics, but they'll also be putting in an infrastructure in Germany and pretty much every casino that you go into in the States. these are cracking businesses that are managed, run out of the UK, and they're global in their own sense. We've got a lot to be proud of.
Mm-hmm. I think our time's just about up, so I would maybe go around everyone and give one last sort of sum up for your view on the UK market or the UK small cap market. 1 or 2 sentences. Who wants to kick us off? I'll chuck it out there.
Amazing place to invest.
Thank you, Dan. No volunteers next?
Just big thumbs up, really.
And Georgina?
Exactly that. I think you can literally feel the excitement, definitely the passion that we have at this area of the market in general, and right now very specifically. Really exciting times.
Great. Well, thanks very much. Thanks for everyone for joining. I encourage you all to stay on for these trust-specific presentations where you can probably get some even more stock ideas to pinch for your personal portfolio if you don't want to just buy the trust yourself, which might be the better option. Thanks very much, everyone. Cheers.